On the domestic front, company news is likely to be relatively quiet. The Financial Conduct Authority is still giving companies an extra 2 months in which to release their full year figures, so any timetable for company results releases is now a bit provisional. We may well get some unscheduled trading updates, but on the short scheduled list, the main names of note are Primark owner Associated British Foods, mining giant BHP Group and retailer Card Factory on Tuesday the 21st of April, and 2 more retailers, Boohoo and WH Smith's, on Thursday the 23rd. As a result, macroeconomic data and the coronavirus outbreak will remain centre stage. Here in the UK, the most widely watched figures will be those pertaining to unemployment and inflation. The Office for National Statistics is due to release those on Tuesday the 21st and Wednesday the 22nd respectively. We've already seen the dreadful weekly unemployment insurance claims numbers in America, which have shown nearly 16 million Americans lose their jobs in just 3 weeks in March. The UK data is a little bit less timely, and this dataset will cover the period for December to February, still a good 3 weeks before the government-imposed lockdown. As such, these numbers won't be anywhere near as dramatic as the American ones, but just to remind you that in the 3 months to January, unemployment was 3.9%, just above the 40-year lows seen last year, and employment was 76.5%, the joint highest figure on record since the government began keeping figures in the early 1970s. The day after the jobs numbers, we get the inflation figures. Weakness in the oil price has been holding this below the Bank of England's 2% target of late, although the much-feared economic downturn won't help much either, and low oil prices aren't unfortunately much use if people aren't permitted to drive very far anywhere. For the record, in February, inflation was 1.7% as measured by the Consumer Price Index or CPI, 1.7% as measured by the Bank of England's preferred CPIH metric, which includes housing costs, and 2.5% according to the Retail Price Index or RPI, which is no longer an officially recognised measure. Given the potentially quiet roster of company news here in Britain, the American quarterly reporting season may be a little bit more illuminating, as these results will cover the 3-month period to the end of March. It seems unlikely that management teams will be able to give any guidance for Q2 or the rest of the year, as is their usual custom. But big names to note include, in the week ahead, IBM on Monday the 20th, Procter & Gamble and Coca-Cola on the 21st, virus testing kit supplier Thermo Fisher Scientific on the 22nd, Intel and Southwest Airlines on the 23rd, and American Airlines on the 24th. But the US name which could just cause a fuss in the coming week is Netflix. The content streaming subscription service provider is due to release first quarter results on Tuesday the 21st of April. As we can see here, this is one stock that so far pretty much shrugged off the COVID-19 outbreak. Having initially gone down as investors scrambled for cash and pretty much sold anything they could lay their hands on, Netflix has, at the time of recording, rallied back above the $400 a share mark for the first time since summer 2018. The firm has, so far, been perceived to be one of those that may be relatively unaffected by the outbreak, as customers binge-watch series after series for something to do, although a prolonged lockdown could conceivably hit content creation and production of new prime content. The company ended 2019 on a high, as it added a higher-than-expected 8.8 million subscribers in the fourth quarter. Chief Executive Reed Hastings has forecast 7 million net adds for Q1, compared to 9.6 million in the first quarter of 2019. Now that's the first number investors will be watching. The second is operating margin, where Mr. Hastings has forecast an improvement from 13% in 2019 to 16% in 2020. Now that figure actually reached nearly 19% in the third quarter of last year, before falling back to barely 8% in Q4 thanks to a huge marketing drive, so Netflix will doubtless be looking to reap from what it has sown this year. Then we come to earnings per share, or EPS. In Q1 2019, Netflix recorded an EPS number of 79 US cents a share. Consensus this time around was looking for $1.62, before a slight dip to $1.54 in the next quarter. If bulls of Netflix love the momentum in subscribers, operating margin and earnings per share, then the one figure that gets bears growling is cash flow, or the lack of it. Netflix ended last year with $9.7 billion in net debt, with an extra $20 billion or so in content purchase and lease obligations on top. Yet it continues to consume cash. Bears argue this can't go on forever, and that at some stage Netflix will have to generate some readies to pay its interest and bills. Bulls argue the more subscribers there are now, the more profit and cash there'll be in the future, so who cares? Bears counter that competition from new rival streaming services could confound that bullish view. Anyway, Netflix consumed $380 million in cash in Q1 2019, So let's see how 2020 began. Thank you for listening. I hope you and your families are all keeping well during these difficult times, and I look forward to talking to you next week.